Everybody. My name is Andrew, and I am the publisher of Crowdfund Insider, and we cover all topics fintech, including online capital formation. This means Reg CF, Reg A+, Reg D in the United States. And today we're going to discuss crowdfunding, what happened in 2022, and what our expectations are for 2023. So today we have three experts once again, and I'm going to ask each of you to do an introduction of yourself, and we'll go around the room so everybody knows who you are. I'm going to start with you, Etan, first person to share what you do.
Thanks, Andrew, and good to see you, Paul and Rebecca. I'm Etan Butler. I'm the chairman at Dalmore Group. Dalmore is a FINRA and SEC registered broker-dealer. We're headquartered in New York and founded in 2005. Today, we specialize in helping companies raise capital primarily online at scale through Regulation A, CF, and D. We've been fortunate to have, as a broker-dealer, onboarded over 275 Regulation A issuers to date. And we also are super focused on providing cutting-edge technology, cost-effective solutions to empower Reg A and CF issuers to effectively raise capital online at scale.
Awesome. Thank you, Etan. Rebecca.
Thanks. Great to be here with this great panel. My name's Rebecca Kacaba. I'm CEO and co-founder of DealMaker, technology company allowing issuers to set up their own online stores and raise through any exemption type across North America and into Europe and some other jurisdictions. We've powered over 1.7 billion in capital transacted, over 700 transactions of all different types around the world.
Thank you very much, Rebecca. And Paul.
Yeah, I'm Paul Stannard. I'm the chairman of the World Digital Foundation, which is an organization to help promote fintech and investment, as well as tech-related companies, organizations, and industries. And I also have a fund out of Europe, which was a tech and a health tech fund, which recently closed out. And we support a lot of companies and equity crowdfunding campaigns that go across North America.
Awesome. Thank you very much, Paul. Thank you, Rebecca. Thank you, Etan. So securities crowdfunding or online capital formation became legalized in the United States under the Jobs Act of 2012. Now, while it was signed into law that year, it took several years for the SEC to approve everything. It wasn't until 2016 that the final exemption was approved, Reg CF. The goal of this legislation, from a broad point of view, was to improve access to capital while at the same time improving access to investment opportunity for retail investors. And I would say that so far, to date, the Jobs Act has been very successful. More can be done, and we're going to talk a little bit about that later. I want to talk first about what happened in 2022, and we're going to start with Reg CF. Steve, if you can bring up the Reg CF slide here. So in 2021, Reg CF received a material improvement. Mainly, it was the increase in the funding cap from 1.07 million, which was rather anemic, to 5 million. This was a big boost for this exemption. Yet, in 2022, the exemption dipped. It went down about by 10%, and this was in regards to the volume of raising, and this was because of the drop in the economic activity. I think everybody has experienced the decline in public markets. It's also impacted private markets as well. We have numbers up there. The average raise during 2022 was 428,000, and the average size of the investment is just over $1,000. So it's a relatively modest exemption in comparison to the other two exemptions. We can jump over to Reg A+. Reg A+ also received a slight improvement in 2021, where the tier 2 segment of this exemption was increased from 50 million to $75 million. This is an exemption that's been evolving over time, perhaps slower than the other exemptions, but it continues to capture traction. Today, a lot of the issuers in the space are real estate offerings, but more and more early stage ventures, or maybe a little bit more mature firms, are using the exemption to raise capital online in a mini IPO type environment. This is because the SEC must qualify the offering documents that are submitted to the commission. And then, of course, there's Reg D. Reg D is an enormous market. There's two iterations here. There's 506B and 506C. It is an over $2 trillion market, and just about every promising early stage venture uses Reg D to raise their capital. Reg D 506C was created under the Jobs Act. This allowed for online capital formation or general solicitation in SEC speak. And this too is an exemption that continues to evolve and grow over time. And typically platforms will utilize all of these exemptions to raise capital. So I'm going to start with the two platforms that we have participated in this presentation to ask what their experience was in 2022. And I'm going to start with Etan. You're big in Reg A+, but you also do Reg CF offerings as well as Reg D2. So what did Dalmore see in 2022?
First with Reg CF. So these are the, we look at these as the greatly underutilized capital raising exemptions currently. With CF last year, 2022, 1,584 companies raising capital through CF, right? It's up from 188 companies in 2016. But what about the other 30 million companies in the US, small businesses in the US, who all have a need for, many of them have a need for up to $5 million in growth capital, either equity or debt. 1,584 companies, right? Just $506 million last year. We are not even at first base as an industry, right? Last year represented 1/3 of the total amount that's been raised, which is 1.6 something in Reg CF ever, right? So literally just starting 1,000 companies out of 30 million. Today, most companies, I guess, don't realize that they could place an Invest Now button directly on their website. So they could raise money from their customers, their fans, their followers, their subscribers, and they could generally solicit as long as it's in a compliant way, right? And raise capital through these exemptions from anyone over the age of 18. I think that one of the issues might be that to many in the space, crowdfunding has been associated with a decision to list your company on a growing number of marketplace-like platforms that list many other offerings in addition to yours, and as well as their own product. And I think that there's going to be a growing knowledge transfer to issuers, to founders, particularly those who recognize that there's value in their customers, there's value in their followers, their subscribers, in the general community, and more are going to be taking their capital raising efforts into their own hands, and learning about these exemptions. I think we're really not even at first base. That's been our experience. Reg A is a bit of a different story. We could get into that in a bit. I know we're going to kind of move on to Reg A, but Reg A has been a very interesting year in 2022 for a number of reasons, which I'm sure we're gonna get more into shortly.
So for Reg CF, for your platform, was it more robust for you in 2022 than 2021? Did you experience a similar decline that other platforms experienced towards the end of 2022? Was it consistent? What type of issuers were pursuing capital raises?
We have not been as focused on Reg CF. We've been more focused on Reg A, right? Or some of the larger issuers who are considering, a $4 or $5 million Reg CF kind of as a bridge to a larger Reg A. We're gearing up to focus a whole lot more this year, 2023, on Reg CF, because we find that, especially since the increase to 5 million that we saw in 2021, today more issuers are considering launching a Reg CF alongside with a Reg D prior to gearing up for a Regulation A. So we're actually onboarding a number of Reg CFs right now. A number of them are about to go live that we've been onboarding over the last number of months. But 2022 for us was really focused on technology as well as onboarding a significantly increasing number of Reg CF offerings, Reg A offerings.
Okay. So 2021 goes from a rather anemic $1.7 million funding cap. I think that was too small from the beginning, kind of ridiculous, to a more feasible 5 million funding cap. Yet in 2022, the volume of funding declined. And, you would think that it would have raised more money, but then towards the latter half of 2022, things got really bad and they continue to be kind of stagnant from what I'm hearing right now. But what about DealMaker, Rebecca? What are you seeing let's start with Reg CF. What are you seeing from that segment of securities crowdfunding?
Yeah, so I have a couple of slides on this we can go through if you like, but for us, CF was a major growth category. So that was consistent with what we saw in terms of the industry deal volume going up. So I think it's really important, like Etan gave us some very specific facts, and let me take a step back and look at it in terms of like contextualizing what CF is doing compared to the broader capital market ecosystem, because that's where I think things get really, really interesting. You've got VC deals declining year over year by 14%, exits declining by 88%, other categories down as well. And then you've got equity crowdfunding up, right? So even when you look at the decline in dollars raised under CF, like it's only a $20 to $50 million dip, which to me is like 10%. And one of my investors said to me last year, and I love it, I quote it all the time, Rebecca, in 2022, flat is the new up. And so to me, if CF is down by like such a minor margin, when all the other categories of the capital markets are down so much, I think that's extremely positive for the equity crowdfunding markets. You're seeing, especially when you consider the check sizes are smaller, right? You're seeing people continue to invest in this category and want to participate in this category in a really meaningful way.
So when you say exits, you're talking about IPOs and acquisitions, correct?
Yeah.
And so you're talking about mainly Reg D issuers that are going to the public markets or being acquired by a bigger firm.
Yeah.
And for your that growth, is that Reg CF only for that last slide, or is that Reg CF plus Reg A plus?
That was both.
Okay, so it's both. All right. Well, that's interesting. I find that encouraging. What has been your experience, Etan, for the Reg A plus sector? Because I know you're big in this space.
Yeah, so Reg A plus 2022, 1.8 billion raised. Now that's significantly up from 175 million in 2016, and it's kind of gone up and up and up and kind of flattened out a bit last year for obvious reasons, or this year. But you compare that to the $148 billion raised through Regulation D 506C, which is only from accredited investors who represent less than 10% of the population. Again, greatly underutilized exemption. I believe Reg A is a superior exemption in many ways, in that it allows you to raise from anyone over 18, and the securities don't have a lockup period, meaning that they could be freely tradable immediately. And that's baked into a lot of strategies for many serial issuers. Yes, you need the audit, and yes, you need to spend money on securities counsel to get you through SEC qualification. And yes, it could take 4+ months from making a decision to actually going live, when you're qualified. But I think that ultimately better serves investors with more transparency and disclosure requirements from issuers. And And I think that it's, that we're going to see a lot of that, that 1.8 billion versus 148 billion. I think we're going to see that flip a bit, especially as the kind of the Web3 blockchain tokenized digital industry recognizes that if you want to fractionalize and issue and facilitate secondary market trading of assets, or and somehow along the way make money off it, which is why they're doing it, it's a security. And I think that clarity has really become a lot more transparent this year with some of the laws that have went into place out of DC. So I think we're going to see an explosion of activity in Reg A. I think we're going to see a lot more sophisticated issuers utilizing Reg A. And I think Reg A is going to be a vehicle that's going to allow private securities at scale to be issued to the masses and ultimately made available to institutional and managed capital.
Okay, so we're
RIA capital.
going to get to your future predictions later, which I want to hear about.
Yeah.
In 2022, how did your volume compare to 2021?
I think it was somewhat similar, maybe a little bit of a drop.
Okay.
But there were I think we grew by over 100, well over 100 issuer clients. Many of them are not yet live. The area that we saw the greatest growth at Dalmore was in fractional share platforms, right? We went from I think 30 to or 20 something to 60 fractional. Now they're not all live now, but these are companies that fractionalize assets like collectibles, music royalties, real estate into small bite-sized shares, set up their own app, their own technology, and build their own communities.
Okay.
So we've seen a real big growth in that area in 2020.
I don't think you do any real estate
2022.
Real estate offerings, and much of Reg A Plus past has been real estate, but you're seeing a growth in early stage issuers utilizing the exemption to raise money online from the masses.
Absolutely, and a lot of real estate we're doing.
You are doing
Absolutely.
a lot of real estate.
Very active. Oh yeah. Many of our issuers are real estate, especially the fractional share platforms.
Okay. All right.
Many of them are real estate.
Rebecca, reflecting on what Etan was, Reg A Plus, what did you guys see specifically on your platform? And then I want you to talk about what was going on with Reg D, because you do the full stack of exemptions. So I'm curious to hear what DealMaker experienced.
Yeah, so Reg A was up for us as a category in terms of deal count, not as much as Reg CF, but still up. We saw more increase in Reg CF, I think partially because we're seeing people, before they have the money and the time to set up a Reg A, they used to do a seeding Reg D. A lot of that is now doing a Reg CF into a Reg A. So as people become more sophisticated with the exemptions, understanding that, they need the audit requirement, getting that done earlier so that they can go and access retail capital. I also thought it was interesting, what Etan said about Reg A doing close to 2 billion. That's a really significant number. And to me, that's new money into the capital markets, right? Like the Reg D money, that's accredited money that's been in the capital markets for a long time. But as the Jobs Act opens up the capital markets to every American, you've got now the everyday Americans investing that 2 billion. And then you also see under equity crowdfunding that minority and female founders getting about 30% of the capital. So to me, that means of that 2 billion, 600 million of financing going to minority founders that previously weren't getting any of that Reg D money. That's a huge amount of new capital going to new kinds of founders with new and diverse business models that wouldn't get funded by the typical Reg D investor, whether it's a VC or whether it's Wall Street. And so that's the impact that I'm really excited to see. I know we'll talk about the future maybe a bit later, but I just want to highlight how much new money going to new types of founders is coming out of that 2 billion.
I want to point out that you don't need to be a platform or a broker dealer to list a Reg A Plus offering. It's helpful if you have a platform that can manage all the nuances, the documents, the issuers, the investors, and all that. So anybody who's on this presentation, yeah, you can put a button on your website, but you do need some people in the background managing the securities offering. So what type of issuers did you see in 2022? Was it across the board? Was it tech? Was it health? What type of firms did you see the most, participating in the exempt offering ecosystem?
Yeah, tech, health, always a steady amount of real estate. There was some Web3, a lot of that for a while. Definitely less of, the cannabis or the psilocybins that you used to see in 2021 and those kinds of years.
What about Reg D?
Reg D, we see everything across the board. I mean, to me, those are everything, we're in many jurisdictions. So from Canada, we've got, the mining or the oil and gas companies doing their kind of accredited investor pre-going public seed rounds, but a standard cross-section of tech, real estate, robotics, consumer-facing brand, makeup, alcohol types of companies.
It's kind of across the board. For a lot of platforms, we'll do a side-by-side Reg CF and Reg D. Are both you two doing that today or in the past? Rebecca, Etan? Rebecca, we'll start with you.
Not typically. Like on our platform, you can set up different portals for different things. One of the benefits, though, is we allow all of that to flow through one portal. So I wouldn't say some portals with simultaneous exemptions is not something we see that often.
Okay, all right.
Yeah, we are seeing an increase of issuers who are launching both Reg CF and Reg D. Usually it's because they expect or hope to raise over $5 million. And in doing so, in having the Reg D going on with the Reg CF, the idea is to direct your accredited investors to the Reg D. And utilize the Reg CF for up to 5 million from not yet accredited investors, right? That's kind of the thinking there. And a Reg D is pretty straightforward and easy offering structure to set up. It doesn't take a lot of time, and so that's kind of where we're seeing generally before issuers are ready for the Reg A.
Okay, all right.
And Andrew, that's something the research that we did across private securities backs up both what Rebecca and Etan said, that basically we're seeing a lot of people maybe thinking that Reg A, they're too early for Reg A, so they want to do a combo of a Reg CF and a Reg D. So we definitely saw that coming through in our research. And in terms of the stats related to private securities survey, the momentum is in the private markets, not the public markets. So back to Etan's point earlier, only 1,000 company on there at the moment. It's the tip of the iceberg with 30 million private companies in America. But once the momentum starts shifting, then that iceberg, can shift very quickly. And I do think, the next year or so, you will see that start to really see that shift more clearly.
Okay, so that's a good segue into what you guys completed recently. World Digital did a survey about the private markets. And so, Paul, I'm going to kind of pass the baton over to you. If you could share the data that you guys gleaned when you did your survey a couple months ago, I would think it is now. So take it, Paul.
Yeah, we did it at the end of the year. So yeah, so I've got a few slides here that we haven't done the whole survey, but we picked out 5 or 6 snapshots from that. I mean, that was 250,000 people that went out to either from people supporting the sector or whether they're investors or issuers. So it was a big survey, and over 30,000 people engaged in the survey, and we had a decent sample size. So I think it's pretty reflective of what what's going on. So if we could go to the next slide. And this slide here sort of, again, tends to back up what Rebecca and Etan were saying about this momentum. 86% of respondents said that they were confident or extremely confident about private securities. And then if you look at the other chart on the right-hand side, 80% are now, considering, fully the, the opportunity of using equity crowdfunding. And then when you actually start thinking about the secondary opportunity, then that becomes even more compelling. But there's a big message still to tell people, both on the issuer side and the investor side, what that actually means in practice. So the next slide sort of deals with some of the, where the issuers and industry said they have been engaged through commercial value from their business. So what that really talks to is, the marketing of all these raises is also having a big impact in terms of bookending their businesses. So, we've spoken to many issuers now that have very large communities and have commercial relationships from their communities beyond just the investment, that actually have bookended their investment in the raise. They've actually, multi growth in terms of their own commercial pipelines, and that I think is going to become ever more clear and important. And then the other stat I really want is this thing about the 27% here of people that have got private company issues. Now, don't forget, this went from startups right across to people that private companies that have got much bigger enterprises and following. But 27% of companies basically had following of over 500,000 people in their community. And if you're going to be successful, you've got to have traction in terms of how you build a community. Now, the 66% said that they had 20,000 or more. Now, when you think that the average conversion rate is maybe going to be, 1 to 5% of that community, you've got to build scale in that community in terms of 20,000, again, is tip of the iceberg. And issuers really need to put a lot of effort and thought into the strategy and planning, as well as the fuel that they're going to put into their marketing through an ongoing, strategy for their campaigns. And it's lifetime value of these investors. We've also seen many issuers that basically have had people say, well, look, the average investment level is less than $500, for instance, but then they've invested 3, 4, 5 times, and on the 4th or 5th time if they've followed this company, they have invested 10-fold, 20-fold the amounts they invested in the early stage, because they're part of that community. They followed the journey. They're going on their regular investor updates, newsletters, webinars. It's a whole ecosystem that these issuers have to put in place with their partners to not only grow their investor community, but also to drive a pipeline for their future business and brand. So I just wanted to reiterate that. And then on the next slide, that sort of deals, I really wanted to talk about the second point, which I think highlights the secondary market opportunity. 84% of private companies, and these are not equity crowdfunding companies, these are some of those 30 million private companies, said they want to find new ways to monetize their assets for investors, their employees in the next few years. So it just shows you the size of the opportunity in that secondary part of the private markets. And then finally, 98% of respondents said that secondary trading was vital to the future of private securities. So I think that pushes that point home. And then my next slide really just again sort of reiterates what Etan and Rebecca were saying, that three key areas that seem to be the top industry sectors for private securities and in particular equity crowdfunding. Real estate is the one that seems to take the most money, but obviously technology and media is strong. But for them to be successful, they've got to have real differentiation, because just having another widget that improves something slightly is not as compelling as a new AI tool that's going to transform how we use Google and maybe even disrupt it beyond like it did to newspapers and magazines 20, 30 years ago. And then the third one in that sector is healthcare. But again, any issuer that's sort of going down that road need to obviously remember, in terms of how they market themselves, the complexities around, you know, compliance of some of those issuers. And then the final slide, I just wanted to talk about which the top three challenges that investors highlighted: accessing qualitative investments in private securities, and I'd be interested to hear from Rebecca and Etan on that point, and tracking and monitoring the progress of these investments and how could they monetize those investments more easily. So that's a summary of quite a, you know, extensive survey of private markets.
Thank you, Paul. That's excellent information. It's very insightful as to what's been going on in private markets in the past year, I guess. So we're 2 months into 2023. Rebecca and Etan, I know that you've already listed new issuers, or you have a lot in the pipeline. You probably have some insight as to where the first quarter is going, maybe the first half of the year. Rebecca, what does your pipeline look right now today?
Pipeline is strong, lots of new filings launching, continuing to see a bit of choppiness compared to, you know, the earlier last spring craze when everybody was coming up and launching. I think people are being thoughtful about the way they're going to set up their marketing campaigns, and that's a good thing. I think that signifies some more maturity in the space as people are now really understanding what it takes and being thoughtful and careful in their planning. But new deal count consistently up. And so I think those trends that we saw last year are continuing on the rise.
CFD A+, it's kind of consistent, or is there one exemption that's more popular than the other?
I think we're seeing the highest growth in CF, that trend continuing with more and more people launching CFs first.
Etan, what's your pipeline look like for 2023 as of today?
Also very strong and growing daily. Also significant number of Reg CF offerings. But what we're seeing also is a trend in, yield-based issuers, right? We have a number of REITs and other types of companies that are offering yield to investors and really building communities. In fact, we have one yield-based issuer client of ours that has sold out three $50 million Reg A's already, and they're on their fourth Reg A. They've been at this for a while, of course. They're on their fourth. It's a $75 million Reg A that they recently launched. They raised over $20 million so far, including $3 million last week. And they have about 100,000 investors. They offer a $10 bond that pays 5% interest and allows for investors to kind of like auto reinvest the proceeds. Just an example of utilizing their own technology, their own apps, building a community, and not looking at these exemptions as a one and done raise, rather looking at them as an investment in building a community that you could bring an ongoing number of opportunities to, whether that is a REIT that offers investors yield, or whether you're bringing them a number of ongoing investment opportunities or assets. That's a trend I think we're seeing. Also, I think, this idea of being super cost effective is really important, particularly to yield issuers, right? So transactional costs, payment processing, things along technology costs, these things are really, I think, going to improving over time. And I think it's critical when you're talking about a REIT that's really sensitive to, to expenses and things like that. So that's what we're seeing.
So that $10 yield product, was that real estate backed or was it something else?
Small business and real estate backed, yeah. And they create these like $10 bonds that pay 5% interest.
So
and have been at this for a while.
It's like a bank replacement.
In a way, yeah. In a way, yeah, right. Yeah. And a number of REITs, more traditional REITs that are paying, between 6 and 10%, return to investors, hopefully, right? Also, really building communities and making it easy for anyone on their iPhone to have access to these potential yield-generating opportunities. That's an interesting usage of the exemption. We look at it mostly, the industry like it's startup capital or growth capital. It doesn't have to be that, right? It could be capital that's raised for access to yield or for access to participation in different assets and investment.
Yeah,
assets.
I think that's important.
So that's interesting.
We regularly have public companies using these exemptions too, and I think that's an area of growth for the category, as well as to the point that Paul mentioned. Right, we've got issuers. And Etan said as well, becoming very sophisticated at understanding that community. They can use that community. Again, we're building tools to support that, our Engage portal, so that they can re-engage with that community, get business benefits from that community, and get reinvestment from that community. And the community can really help them build the company.
Rebecca, quick question. Are you seeing valuations come down to earth? Because you're seeing that in other private markets. Of course, you see that in public markets too, where you're getting, the compression on the ratios. Are you guys seeing different valuations?
I think
Q1?
Anecdotally, we've seen valuations come down, and I don't monitor it. I'd be curious if Paul, if you have any stats on it, because it was interesting to me that more founders would choose equity crowdfunding over VC, where they do get more control over their valuation, right? They're not having to negotiate against those pref shares and against that valuation set by someone else. So that's great that people are recognizing the benefits to the founder. So
Paul, you actually you bring a good perspective because you look at it from a different point of view than these two platforms. What are you seeing?
Yeah. So again, we didn't actually ask specific questions about valuations, but anecdotally, there has been downward pressure on valuations across the board. But in reality, as Rebecca said, you've got more control over what you do, and valuations. It's more in your control. But investors are, because it's in the public domain now about valuation, especially around tech. So, people are asking more questions, aren't they, around that subject matter. And the other thing, back to Etan's point, one of the things that did come up again in our research was about these recurring interests, like your bond or replacing a bank borrowing, was around is there any sort of benefits or increases where for the lock-in period? Because I imagine with a lot of the real estate wins are linked to some kind of lock-in. And I was talking to one the other day that had very similar success to what you were talking about, Etan, in terms of raised a lot of money in the last few months that way. And there were different motivations for different investors in relation to the lock-in.
Okay. All right. Thank you, Paul. So I want to jump to the future now. I'm going to start with potential changes in the exempt offering ecosystem. Everybody on this panel understands that the Jobs Act 4.0 has been a discussion point for some time now, some months now. The changes on Capitol Hill means that we're probably going to get some better legislation coming out in the next few months. And recently there were two hearings at the House Financial Services Committee, and both of them I found interesting and perhaps helpful for the industry. And I want to start with the first one that I watched. I watched both of them. The first one is definition of an accredited investor. And from what my point of view, it looked like there is bipartisan support, Republicans and Democrats, to support broadening this definition. And I'm going to start with you, Rebecca. How would this impact your platform and issuers if that change took place?
I think that would be a welcome change. Listen, anything that makes it easier to get a raise off the ground is better and going to cause more capital to flow faster, right? So we can code up those changes in our system very quickly. That's good for us. But the main thing is that you can't digitally market a Reg D or an offering to accredited investors. It's not cost effective to do so. So maybe if those changes take place, you can more broadly market those Reg Ds and get a raise off the ground faster. That to me would be the biggest impact.
Etan.
I think we have to be cautious at the same time, because these exemptions are very new. We just 1,500 CFs, 1.5 billion. It's still very early days. And when you allow not yet accredited investors, oftentimes for the first time ever, to invest in startups, and you allow the startups to utilize marketing and promotion, I think you have to be cautious, and I think you need to be a little bit slow. So part of what I like about CF and even more is that there are additional requirements for issuers, disclosure requirements, audit requirements. That are different than they are for Regulation D. Regulation D, very light. You could get an offering up very quickly. So while it would be nice, I guess, to an extent, to have not yet accredited investors have the ability to participate in Reg D, something about the fact that there's more disclosures and it's a bit tighter to push them more towards Reg CF and A in that way seems like it makes sense to me for the early days. But there's also talk about tightening the definition of an accredited investor, right? And that would drive more potential investors to CF&A. But I really see the upside here, the future in Regulation A ultimately, because that immediate path to potential liquidity and the ability for anyone pretty much in the world over 18, other than a number of problem countries, to participate really is, that to me is the most exciting exemption.
Okay. So the second hearing that I watched was on access to capital, effectively supporting entrepreneurs. And I'm going to quote one of the panelists here who said, unquestionably, the current regulatory environment is unkind to being either a public company or a private company. There is a culture of regulation by enforcement, as well as the convenient reinterpretation of rules and regulations that have been on the books for years and years. And I think there is a consensus that the cost of being a public company is too burdensome. As well, I think that the compliance costs pushing firms to remain private for as long as possible. I'm going to start with you, Rebecca. What are your thoughts on that?
I think, yes. I mean, I agree. There's generally acknowledged a huge burden to being a public company. And, that was one of the reasons I got into this business, was I saw a lack of infrastructure for the private markets that needed to exist so that founders could go about their business and focus on building their business instead of having to spend so much on legal expenses and trying to manage that for themselves. So that is the very reason that I built DealMaker, and we built all of these tools so that you can manage your shareholders digitally. And so as ATSs, I see in the chat a lot of questions about ATSs and trading in the private markets. I think that's the way of the future. I think Reg A and Reg CF continue to be the way of the future. And as technology allows people to do more within the private markets, they have less and less of a need to go public, but every American can get in while a company's private. I think that's a beautiful thing.
Etan, thoughts?
I I believe I feel in a similar in a lot of ways. I think that the rise of the ATS is going to be a big focus that we're going to be seeing this year and next year for obvious reasons. We're going to see more issuers utilizing Reg A and Reg CF. We're going to see more securities being listed on ATSs across the board. And we're going to see, I think we're going to be seeing things like market making as well, right? And real more mature markets. And I think we're going to see a bridge, a really firm bridge established between the production of private alts and managed capital, RIAs. I think that's really what we're going to see.
Paul, I'm going to ask your opinion on that too, about the regulatory environment is not very kind to being a public company or private company. What are your thoughts on that?
Yeah, I mean, in a different life, I've been involved in 3 IPOs during my career, and the pain and challenging some of my colleagues that I've worked with in that process that were at the very front end of that. I remember it like it was yesterday. So, anything that basically delivers a smooth path, but also gives regulatory cover and confidence, because regulation isn't a dirty word, really, because if you have good regulation, you get confidence in the market. If you look at what happened in the public markets 25, 30 years ago, when all that lit up digitally, it actually allowed, there was more regulation at the beginning because it was the Wild West of that day. But ultimately it just opened the market up. And as confidence and trust grows, then I think, Regulation A, particularly, and CF for the smaller companies is going to open up to a much wider audience, because I've taken a number of calls recently, one from a company that's been established in America for over 100 years, that's now looking to deploy a household name in America. I won't name them, but they're looking at completely different way of capital formation, how they're approaching things. Now, they would have laughed at this probably a year, 2 years ago, but now they're actually taking it seriously.
Okay. So I think you make some really good points there. Since the two of you, Etan and Rebecca, mentioned secondary trading, one of the acts of legislation, pending bills, address secondary trading. As the two of you understand, for Reg A Plus, for the primary issuance, you get state blue sky review exemption. Do you think that should be the same for secondary transactions, Etan?
I leave it to my friends like Doug Elinoff and others who are staunchly advocating for us to really focus on that. I don't know. We've been more focused on the current regulatory framework and advising issuers on how to navigate through that framework today. But as far as blue sky, I think ultimately whatever is in the best interest of investors should be pursued, because that's what's going to ultimately be the most sustainable for everyone.
Okay, Rebecca.
Right. So
Rebecca, secondary trading.
Yeah, I think I stand with Etan, and I'll leave it to Doug a lot, but I will say, like, blue sky is complex, right? You see people making mistakes with it. And so I'm always an advocate of legislation that's clear and can be properly complied with in order for it to serve its purpose. And so I know if you look around the world, like, state filings are something that trips people up in a lot of ways in a lot of regions. And so you have to be careful with it, right? Because the point is not to create so much complexity that you dampen the markets. And so that's the balance.
I think you're an advocate of providing another path to liquidity for investors beyond an acquisition and an IPO. You agree that secondary transactions should be streamlined, don't you?
Absolutely. And I don't think we are still at the gates of the door. So you know, I can remember, you know, being an ex-media owner, talking about the year of the mobile, and it took 8 years before you know, we had one of these things, you know, to consume media. And now look, you know, we can't take ourselves away from the dining table to, you know, to talk to family and friends. So I think secondary trading in a few years' time will be as commonplace in the public's perception as it is the finance world, because everyone is talking about it in the corridors of this world and Etan's world and Rebecca's world. But it's when it's on the lips of the man in the street, it then becomes perception is reality. And then I do think secondary trading, you know, opens up all sorts of opportunities for those 30 million private companies who, let's be honest, their shareholders are stuck there on average sometimes for 15 years with no guarantees of how they exit. You know, it's got to be the future, and also it will change the dynamics of the VC markets and everything else within private securities. Which, as somebody who's raised capital for my businesses over the last 30 years, I know where I would rather have been raising capital 30 years ago. So, yeah.
Okay, so I'm going to share a couple of issues, some revolving around draft bills. Should Reg CF be increased from 5 million to 10 or 20 million? Rebecca?
Yes.
Okay. Etan?
I think so. Yeah. I mean, it's a quicker path for issuers to position themselves to raise capital from anyone over 18 than Reg A, right? And so I'm all for it. I think we've all benefited from the increase to 5 million. I think 10 million sounds like a good number to look at next.
I think it sounds good. I don't think you get any pushback from anybody on this panel, unless Paul, you think it's a bad thing. I think you're
No, totally agree. It brings it closer and brings more people in.
Another issue I want to touch on. A lot of the challenges in Capitol Hill and Washington, D.C. have to do with risk. When you invest in an early stage venture, a private firm, the risk is higher. Of course, the expectation is you'll have a higher rate of return if it succeeds. It's just like other forms of venture capital. What about a tax exemption that mitigates that risk? We'll start with you, Rebecca. Do you think that's a good idea to support the ecosystem, support entrepreneurship, and support mitigating risk for smaller investors?
I think it's a phenomenal idea. You've seen it work in other jurisdictions. You know, UK and Canada have similar things. It allows you to propel forward the ecosystem without so much government involvement, like government incentives. So you really allow more people to get involved and see the benefits of the ecosystem and give it a bit of a kickstart. So I would be a big fan of that kind of change.
Etan, for or against?
You're for. I mean, you're also creating. What are you really doing here? You're creating jobs. You're giving female and minority-owned business owners a more leveled path to pursue their dreams in an embarrassingly low VC environment of less than 1%, 1 or 2% going to them. That's what's going on. So I think the government should be fully supportive of that.
Paul?
Yeah, the EIS scheme that happened in the UK, you know, I utilised that 20 odd years ago, and you know, it you know, America, you know, the home of where most people go for finance, you know, in the Western world, you know, I think it would be transformational, and it's empowering as well. It's massively empowering to do that. And you know, I think it'll actually put tax dollars back into the government as well, because you'll be creating more productivity by empowering the actual public to invest in early companies.
Yeah, agreed. Subsidizing innovation. So we're coming close to the end of our panel.
Absolutely.
I want to jump to the Q&A part of the session, and I'm going to try and pull up a few quick questions here. Let's see.
While you're doing that, I think the other thing it would do is incentivize some of the unregulated offerings to become regulated, right? And so that has a net benefit to the whole ecosystem as well.
Okay. What are the ballpark costs for each exemption, each type of raise? This is a Rebecca Etan question. Etan?
Reg D is really whatever your securities counsel is going to charge you for the kind of the corporate docs and the subscription agreement that you need for the offering. Reg CF is going to be probably a little bit more than that because there's usually like a due diligence expense that the broker dealer or funding portal will charge you. Some charge that up front, some take it out of the proceeds. The commission structure will range as well. For Reg CF, some of the marketplace platforms that are out there expect to spend around 7-8% or so in that range, whereas it's about half of that or so, at least when you're doing it more on your own, with at least with a group like us. And then on the Reg A side, it's more expensive in the CF in that you need SEC qualification, so you should be prepared to spend on average $60,000 or so for securities counsel. It goes up or down depending on who you're working with, but that's an expensive cost as well as the audit, right? And then whatever a broker dealer. So I would say for a Reg A budget in the $90,000-$100,000 range, as far as sunk costs to get to the point where you're qualified, is probably a fair number to consider.
Rebecca?
Yeah, I agree. And then on the marketing costs, I saw there was a question there. I think, you're going to want to budget certain amount to get the assets developed, anywhere up to $30,000. And then you're going to want to budget a monthly marketing spend to figure out what's working. You want to start small and then grow that spend. So we would say to earmark, anywhere from 60 to 90,000.
Yeah, and Paul, you come at this from a different perspective. What are you seeing in the broader ecosystem?
Yeah, I think the reality of it is that there's a stat out there that there's pretty significant. A third of the smaller raises foul completely. A third get somewhere towards their goal, and a third are successful. And if you apply that to preparation and planning for these campaigns, especially around the marketing and the foundations of building a community, and then putting marketing budget to do the learning, so you can find where your audience is for your community of investors. You've got to have that money, and you've got to have enough money to back it up, because trying to find that vein is not straightforward, because every issuer's proposition is different. And if you don't put enough money aside, it's a fear factor. CEOs get frightened, and then they start to retreat, and then they make bad decisions. They throw the money away they've invested because they didn't have enough money to see through the learning. And I think that is fundamentally the biggest hurdle that issuers face, is they don't know what they don't know. And then when they go into it unprepared, without enough money to see it through to success, that's where the real problem is. And I've been speaking to a number of international organizations that are thinking of, and this has been done in the UK as well, not for crowdfunding, but match funding. So they basically say, well, I'll put some money in, I'll invest early in your equity crowdfunding raise, and I'll give you another $50,000 towards the marketing if you're going to put $50,000 in. And I think there's going to be lots of other ways to encourage issuers to do it the right way. And I think it's failing to prepare and not having enough money to sit through the learning process to find, where the gold is,
Yeah, I think you make a very important point, Paul. You need to plan, you need to expect to donate funds to make this work, and you need to work with people that have experience. And that means attorneys that have experience in the sector. You don't just up your local guy and say, hey, can you do this for me? He'll say yes, he'll charge you too much, and he'll mess it up. Don't do that. Work with providers, platforms that have experience in the sector. I cannot emphasize that enough. I'm going to jump to another question, a regular one. In general, how long does it take? Is the timeline going to diminish for getting offering documents qualified? How long does it take to raise money? Etan and then Rebecca.
CF, you don't need qualification. It's a notice filing called a Form C that's filed after diligence is done and the offering is ready to go live. So that's something that you could make a decision you want to launch a CF, and theoretically you could be live within 6 weeks or so. It oftentimes takes longer because depending on how much you're raising, there's different financial or audit requirements and diligence requirements, but that's something that could be weeks or maybe just a few months. Reg A does require SEC qualification, and we're seeing qualification happen, let's say on average 60 or so days from initial submission to the SEC. So however long it takes you to get your offering circular completed, which is an extensive doc, that could be a month or two. That's why for Reg A, it's usually like that 4+ month period, 4 to 6, and even longer than that, depending if there's back and forth with the questions or comments from the SEC. So that, and whereas a Reg D it could be up and running, really quickly.
Rebecca.
Yeah, then once you're live, we typically see the Reg CFs live about 4 to 6 months. Reg A's keep them open 12 months, sometimes longer. We have some, real estate issuers that continually file and keep their Reg A live and open. So that's the nice thing, is it gives you that time to ramp up what you're doing, figure things out, figuring out how to do the marketing spend, and then ramp it towards a nice big closing.
What type of success rate are the two of you seeing on your platforms? Etan, issuers that raise the money they want.
Well, it's an interesting question because oftentimes a Reg A offering, there's no minimum, right? It's not a min max, right? So they're able to close on initial funds that are raised. So how much are they looking for? If you look at the amount that the offering is qualified for, let's say $75 million, I would say very small percentage are raising the full amount that they're qualified for. But it really depends. You see, we certainly have our share of issuers who have raised the full amount relatively quickly for a number of reasons: a big community, great marketing, great PR, and we also have our share of issuers that have not succeeded anywhere near that they or their board would have liked. They didn't have the right messaging, they didn't have the right budget, right? And that's certainly a risk in setting this up. You really have to be prepared because ultimately you're going to be an island on your own, and it's your job to get enough people there who care about what it is you're doing, so much so that they're going to go through the funnel of making a payment and signing a subscription agreement to become a shareholder. And that takes time, and that takes focus, technology, and capital.
Yeah, there's an old saying once said, the best mousetrap doesn't win the race. It's the one with the best strategy and marketing plan.
Absolutely. And I also think it's important to highlight the rest of the industry, right? Because I was a capital markets attorney for over a decade. So how many banker-led deals did I see where the bankers go out and they promise the world and they promise a $30 million raise, and that doesn't materialize? And how many pitch decks go to a VC? Out of 50 pitch decks that go to a VC, how many of those founders land capital from a VC, right? Very, very few, like 1 or 2%. So then you look at the Reg A market, right? And Reg A issuers last year raised $1.8 billion, and the offering documents indicated they were looking for $6.12 billion. So you're looking at 30% of the sought max capital raised. And let's remember, the max capital they put on that offering document, everybody's putting the max amount. Sure, I'd love to raise 75 million. Realistically, am I good with 10? Yes. So when I saw that stat, that 30% being filled, I think that's phenomenal. And that's one of the reasons I think we're only in the second inning of the amount of capital that's going to be raised under these exemptions. Because if I spend 100 grand and even in an unsuccessful offering, okay, I raised $1 million, my business still has 900 grand that I can build something with, versus, a lot of banker led deals I've seen that just end up with zero.
Okay, so we're really running out of time. We're actually over time. I'm going to ask each one of you, starting with Paul, to share your predictions, your expectations for 2023 in the private markets ecosystem. Paul, what do you predict?
I predict that secondary trading will get past the gates, the front gates, to a bright future in the coming years. And I think issuers will start getting savvy, because I think there are good actors out there that are being very direct and honest with issuers about, what expectation looks like. Because I think 2 or 3 years ago, when I started entering into the market in the US, there were a lot of people making a lot of promises, and there was a lot of big claims and promises going on. And I think it's starting to get, the whole industry is starting to be honest with everybody and realistic and telling what has got to happen. And I think that will bring new issuers and more mature companies to this space, as well as, so I think better deal flow will increase the investor flow. So if you get both of those things coming together, I think by the end of this year, I think equity crowdfunding and private securities will continue its momentum.
Etan, predictions for 2023.
I think we're going to see significant dollars of private assets being fractionalized and freely tradable through alternative trading systems. I think it's going to happen with real estate first. I think we're going to see an increase in tokenization and blockchain technology being utilized and included in more issuers' capital formation strategies. And I think we're going to see a consolidation in the industry amongst platforms and portals and broker dealers. And many of the VC-funded new participants in the space are going to be dying on the vine because they can't continue to burn, and it's very difficult for them to raise money from the VC marketplace in this environment. And I think we're going to see the NFT and crypto industry transition further into a regulated framework to participate in the US, and that's going to come through Reg A and in some cases Reg CF. And finally, I think we're going to see, like I mentioned before, a bridging of the gap between the production through these exemptions of private alternative investments and the ravenous thirst amongst institutional and managed capital accounts for private alternative investments be met in a format that allows for RIAs to more easily allocate client funds to some of these opportunities and assets.
Last but not least, Rebecca,
I think
2023.
More deals, bigger brands, and a huge spike in volume come, about September.
Awesome. All right. I would like to thank our three panelists, Paul, Rebecca, and Etan, for joining us today and sharing your wealth of knowledge. And I would like to thank everybody that's here today that has watched this presentation. I believe that the links to the presentation will be emailed out afterwards, perhaps later today, and so people can go back and review the webinar and the session. So thank you again. Be certain to sign up for our next webinar, which will be happening in March, I believe the 22nd. Everybody have a good day and the rest of the week. Thank you.
Thank you, everyone.
Bye-bye.